Welcome back to the channel. I hope you had a fantastic weekend and start to your new week, just 1 week out from Christmas. And we tend to see these markets drop off with volumes as more people go on holidays. And so we want to answer the question today, are stubborn investors about to get absolutely crushed and destroyed into 2023? We have the S&P to go through. We have Dow Jones with a new bullish signal following last week's daily closes, and of course Bitcoin as well. Make sure you have subscribed to the channel with the bell notification icon. Check out the previous videos that I will leave a link to at the end of this one so you can stay up to date with all of the macro analysis coming your way for the traditional markets, the real estate cycle, and of course Bitcoin and cryptocurrencies. So the first thing I want to start off with today is the liquidity here. So there's a pretty good post here looking forward into 2023 and what we may expect based on the last 14 times here in history, going back 62 years, of how much we could see the markets go up in 2023. I know this is quite contrary to what a lot of people believe is going to happen in the markets. A lot of people are still waiting to see whether we're going to get a recession and all these sorts of things. But we just take a look here, looking at liquidity is paramount, so liquidity in the market. Fed pivot less important than liquidity pivot. So the last 14 times, only one of those times we had a negative result. And what are we looking at here? Essentially, we are looking at the liquidity drying up in the market. So annual growth in US real M2 money supply. Each time this has gone into the negative, so the money supply drying up, the liquidity drying up, the following 12 months forward, percentage change. So it's not only when this goes into the negative, but essentially where the bottoms come in this liquidity supply. So when the liquidity dries up, you can see number one here in 1960, the next 12 months, the market went up 13.6%. You got 0.2, 3, 4, 5, and these are the big negative ones here. And then of course, through the 90s as well, when the markets dried up, the following 12 months all had positive results on the S&P. And where we find ourselves now in 2022 is very much a liquidity draining. We're losing liquidity out of the markets. And what we've seen in the past, like we've noted here on this particular chart, markets have gone up from this point. From the lowest end, from the 0.9 here in the mid 90s, went up 2.5%. In the highest reading, we have 31% here at number 4. So one of these negative readings. If we take a number somewhere in the middle, you could probably look at something like 15% from this particular area here. Now, even if it is only a 2% increase, that is vastly different to what the media is saying, what a lot of people are expecting, because a lot of people are expecting 2023 to be quite negative, very, very negative. The only time we've seen here in terms of the negative is number 12. So we had 12 here in 2008. And that was basically the only time that we saw a negative move on this particular index where liquidity dried up. The following 12 months, it was negative again. After that point, absolutely positive. We know that from history. 2009, quite positive. 2010, quite positive as well on the S&P. With trading and investing, there's nothing that is 100%. So to see a negative here, I think is quite positive because we do have a sufficient amount of data to read from. Often when you only get a reading or a signal or an indicator that gives you a 100% accuracy reading, there's generally not enough data given. Similar things we see on Bitcoin. There might only be 2 data points or 3 data points, and it's happened every single time. But these will eventually fail. And then if you're just believing that it happens 100% of the time, when it does fail, it catches you off guard. That can be very detrimental to new investors as they look for comfort and safety in the market. Remember, there is no 100% guarantees in this market. We have some more signs of the economy recovering, or at least not being as bad as what we're led to believe. This particular data here is the diesel back down to pre-war levels. US winter supply crisis has eased as stockpiles build. We're seeing this in Europe as well. We've seen it in the UK, and we're seeing natural gas prices fall. They're quite a long way from their highs where the major drama started. And in this particular case, these levels are below, back down to pre-war levels. And I mean, the trend is still down, and we could potentially go below these particular levels. And so the fear that is around Europe freezing over this winter, people not being able to afford their electricity bills, may in fact just be another fear piece from the news to try and push these markets further down, for these buyers to come in and start scooping up some of the bottom prices, not potentially the exact low, but around those bottoms. So we're not seeing the fear as bad as what the media is making out. More data in from China as they look to rebound from zero COVID. So there are signs of people starting to go out again. This is in the December road traffic. This is in Guangzhou, is ground zero for the latest infections. And so you're starting to see a rise here of people leaving, people going out again, which means their economy is starting to churn over again. This was the problem before. Everyone was locked up, away at home. Really tough measures been put out there by the Chinese government. But now we're starting to see this pattern reverse. You can see here on the brown line, the numbers have gone down in the millions and they're starting to recover here. The levels were as low as they were back in 2020 when everything broke out. Obviously 2020 bounced away into 2021, which was the green, had a drop off again and then drop off around mid-year. These are the days within the year. And then within the brown line, which is the current year, 2022, we're starting to climb out of these lows again. So we might be getting a little bit of a move on in that economy as well, which is going to help open up supply chains. More news and data around real estate and land prices continuing to increase, maybe after a slight ease off in prices, because nothing goes up in a straight line. Things do have to pull back, especially after certain prices have gone up 70%, 100%. You must see a correction in those prices. In this case, we've got a couple of examples here from around the world, and we're seeing similar things in Australia, in the US, and the UK. Here in Singapore, we've got expats face up to 70% rise in housing rents as prices hit record highs. If rents are going up, the property prices will continue to go up as well, because that will increase the yields. If you have higher rents, you're going to be able to make a higher return on your asset. And people then start bidding up the prices of those particular apartments, land, property, commercial, whatever it is they're buying. Those assets will continue to go up in price because those yields are high until the yields start to come back a little more. We're seeing that in Singapore, of course, as I said, in Australia. Dubai's luxury home prices have nearly doubled in the last year as well. And these are only two small markets around the world. I understand that, but I'll be bringing you more examples of where this is coming from around the world. US, UK, Australia, Canada, you name it. This sort of thing is going on right around the world throughout these next few years into the last half of the real estate cycle, and then things will fall into a collapse. I'm not a perma bull, but there is still some more life left in these markets despite what we're being told out there in the media. Another major signal here, at least for the TA crew, on the daily chart for the Dow Jones, which is essentially the 30 major stocks in the US. In the last couple of days, it has had a golden cross. So the purple line here you can see is the 50-day moving average. 50 days here, 200 days is the green, and we had a crossover on that just on Thursday. A golden cross is typically a bullish sign. My preferred analysis is to use the yellow swing indicator. This is that yellow zigzag line that you can see here. It's a custom indicator that we have created at the Investor Accelerator, so you can find this. I've got a link in the video description. It helps with trading setups, looking for profit targets, stop losses, and keeping yourself safe in these markets to advise when the market is about to turn down or go into a bull market. But looking just specifically at the moving averages, a lot of people do check this moving average. This is your death cross as the 50 crosses under the 200-day. And then you've got the golden cross as the 50-day moves above the 200-day. Like we know with trading and investing, there are no signals that give a 100% guarantee. You can see the death cross happened here in August of 2015, had a golden cross, a quick death cross, and then a golden cross again. And then the market basically boomed up from that point. So should we find ourselves in another position like this, and we haven't completed the golden cross, we fall into another death cross, you can see that the lows were relatively similar to where they were previously. Now, if you go back into history, you can go back 50, 60, 70, 80 years using this particular signal here, the moving average. There will be times where the lows do come in a little lower, which is why it's important to always use multiple indicators, not just this one indicator to let you know that the bulls are back in town. But nonetheless, it is another indicator that has worked in the past, provided it is used in conjunction with other signals. And as for Bitcoin in December, we are still sitting at around $16,700 as we followed up with our predictions video here. So this is our December predictions. You could go back about 2.5 weeks now. We looked specifically at December potentially being a lower price, but only marginally, like what we've seen in the 2008 bear market. It went about 10% down. Some charts are showing 9%, others show 10%. So basically from that November low to the December low, approximately 10% difference here. And what we've often seen in history is when we get one of these capitulation type bars where the market is shocked, we drop and we try to test those high prices, we do get a little bit of a lower price or potentially sit around that same low price. So December is going to be an interesting one as the volume starts to dry up towards the end of the month, and we're nearly into that stage now as we lead into Christmas and New Year's. And then essentially the volume and the activity may start to come back in the first or second week of January. As I mentioned in the intro of the video, this is a period of the market where stubborn traders or investors could potentially get absolutely wrecked. It's important to take a look at both sides of the market. And of course, I'm also one to be known to be biased onto one side. I'm very much more bullish at the moment where I think the bottoms are coming in, not necessarily that the bottom is in, but the bottoms are around this particular level. And the downside risk seems pretty reasonable compared to where I see the reward to the upside going. However, there may be some investors out there that are looking to much, much lower prices, and that could be a point where they get absolutely crushed by the market. If we see the market begin to rise, those investors are going to begin to get FOMO and hope and hold on for lower and lower prices until it's too late. Those market prices are much higher, and at that point, they sort of FOMO into the market. So I bring this quick little tweet up to you here. Can't wait for a pullback. It's too risky to invest now. It could be almost at the same price that we were 5 years ago in the case of Bitcoin. And right now, people are saying it's too risky to invest, or they're trying to be greedy and wait for much, much lower prices. Assess the downside, where you think the absolute worst possible price of Bitcoin is, if Bitcoin is the poison that you choose to invest in, and assess what the potential upside is over the coming period that you're interested in. Is it 1 year? Is it 5 years? Is it 10 years? And so don't forget that in case those price targets never come, in case we never see $10,000, in case we never see $8,000 on BTC. And the last quote I'll leave you with is from Immanuel Kant. The wise man can change his mind, the stubborn one never. If you've been in this game long enough, you know you will have to change your mind. You cannot be stubborn in this and expect a particular price to have to happen because someone said it does. So I'll leave you with that quote there, guys. Make sure you are subscribed, like the channel up, check out the videos that are popping up here on your left-hand side. Plenty of more macro content coming out throughout this bear market across crypto, real estate, and of course, the traditional markets. Catch you guys back here on the channel tomorrow. Until then, peace out.